Can an SBA loan actually help your DTC brand scale? Today's guest is an SBA wizard, and she's going to help you decide. All right, today I'm here with my good friend, Roxann Burns, SBA Lending Executive at Fremont Bank. I call her the SBA Oracle or the SBA Encyclopedia. If I ever have an SBA question, she's immediately the first person that I reach out to. I've known her for quite some time. I met her when I was at Guardian Bikes, actually, when we got a couple of SBA loans, learned a lot about the program, some good lessons, some tough lessons, and I'm excited to have her on today. Roxann, how are you?
Great. Thank you for having me. I appreciate it.
I was
I'm
telling Roxann
excited to
before
share.
we hit record because we've known each other for a long time and we've had lots of philosophical conversations about debt versus equity, when to use it. And I said the hardest thing about today's episode is going to be to keep the conversation to less than 2 hours because we've had plenty of those really long conversations. But before we dive into talking about whether or not SBA loans can help a D2C brand scale, can you just give us the brief story of who you are and what really got you into SBA lending?
So, I have a master's in public policy and administration, and I did an internship in grad school for the state with the state of California and got introduced to SBA lending in that role as an intern. Literally got a stack of financial statements and was told to spread them and had a spreading, a credit underwriting manual. And I spread, this tells you how old I am. I was spreading with a pencil and paper. Okay.
That's great.
Lotus Notes was the kind of the new thing. So yes, and once I got the bug, I mean, I dropped my master's thesis, I changed everything, and I wrote my master's thesis on financial literacy as a direction in small business development policy. Because even at the very beginning, I could see I'm over here underwriting, your financial statements and realizing that the person on the other side doesn't have the knowledge of, what those financials are telling me. So you're telling me this and your financials are telling me that. And this is a common theme. All these years later, that analysis still is true. It's probably one of the gaps. You see this a lot.
Yeah, Roxann and I'll try not to go on a tangent. We've had numerous conversations. I'm smiling because I'm numerous about the need to educate the marketplace on understanding balance sheets and the interplay of the balance sheet with the P&L to ultimately understand cash flow. I knew when I met Roxann that she was not like most other bankers. She understood or had a passion for understanding how the business actually works. And that was definitely where we hit it off. Much more entrepreneurial than I'd say most, if not all, bankers that I've really dealt with in my life. And so I'm excited to dive into the topic of SBA loans. So to set the stage, before I ask you my first question, what I want the audience to understand is SBA lending is something that the reason we're talking about this is because it comes up a lot. Like entrepreneurs, early stage, lower to middle market, SBA is this enticing form of capital you can raise, and you tend to hear either like horror stories or success stories, but a lot of people don't really understand how SBA works. I know that I didn't until I met Roxann. And so just to start out like basic bare bones, what are SBA loans and what are kind of the major criteria that help a company either qualify or get disqualified?
So there's a couple of SBA programs, but the general concept in the major loan program is called a 7A loan. That's based on the regulation or the statute, and it's a guarantee. So I make a loan to the business for $100,000. I get a 75% guarantee. Now that is not a fixed guarantee. It's a loss guarantee. So let's say something, happens and I have to liquidate that loan. Whatever loss the bank takes, I'm going to get 75% reimbursement from the SBA as long as I followed the program requirements. So unlike in the mortgage secondary market, in the mortgage guarantee world, all SBA lenders have skin in the game. And I think that's why this program has been around since the 50s. and still going strong today.
So it's very interesting, right? So the lender has skin in the game, but if the lender has followed the protocols, the SOP set forth by the SBA, if the loan defaults and you end up having to basically foreclose on it, you can get a 75% guarantee from the government. So from the lender's
The
perspective,
loss. Yeah,
of
of the
the
loss.
loss, yes. So from the lender's perspective, how does that change how does that change the box for who can get an
Yeah.
SBA loan versus a conventional loan?
Let's just go to the first question you asked me, and that are what is the major criteria? The number one major criteria is you have to be small. And this seems like it's made, if you do research, there's industries and there's number of revenues and there's number of employees. But at the end of the day, SBA has an alternate size standard, which I think is easy. It's a tangible net worth of 20 million or less. It's a very big company. And its average profits 2-year average profits after federal income taxes of 6.5 million. That is a pretty big company that can qualify
Absolutely.
for an SBA loan. So
Interesting.
it's takes you from, I guess, startup all the way to something that big.
Are there any qualification criteria around like the net worth of the owners, or is it specifically around the net worth of the business?
That initial criteria of what is considered small is the business. So we're looking at the business, and I would say the business and its affiliates. So if you have affiliated business where there's ownership control, of two companies or more, those would be considered affiliates. And then there's a size standard, but that size standard applies. But from an individual standpoint, the SBA does have what they call a credit elsewhere test, and that's another fundamental concept. The credit elsewhere test basically is the lender cannot make this loan to this business if they can reasonably get credit from another source on
Mm.
similar terms. Okay. So that's the key in that is the similar terms. And the third criteria, main thing about SBA loans or the advantage is you have a lower down payment or a higher advance rate and a longer term. So what we might do on a non-SBA loan, a 5-year term or a 25-year amortization on real estate due in 10, with the SBA guarantee, we could do it fully amortized on like working capital equipment, business change of ownership. We can do a 10-year fully amortized loan, and on real estate, we can do a 25. So you're
Yeah, see
really
that's huge because basically what Roxann is saying is if you compare, say, a 7-8 term loan that you're going to use for general working capital purposes versus one that you would get a traditional term loan outside of the SBA program, you're going to have to pay that traditional loan back faster, generally speaking, oftentimes in like 5 years or less, as opposed to 10 years. And I remember one of our advisors at Guardian Bikes, when we were looking at that 7A loan that we did with you, he was like, and interest rates were obviously a lot lower back then, but he was like, hey man, a 10-year term loan, he's like, that's, if you factor in inflation, he's like, it's basically like free equity
equity.
dollars,
That's
right?
why I say
Now,
it's equity-like.
yeah,
Yeah,
it is.
because
It's
we just have
equity light.
yeah. And it really that longer term also reduces those payments and from somebody who manages portfolios, right? So I have the accountability for the quality of the SBA loan portfolio. The default rate on generally on and my SBA portfolio compared to the non-SBA portfolio is about the same because that longer term enables businesses to, even when they're struggling, to keep eking out those payments versus if they had a much larger monthly payment to make.
Interesting. I'm reading a book right now about real estate investing called Start with Strategy, and it talks about financing strategy. And one of the first concepts that it goes through is time is your best friend when it comes to financing real estate. And what he was getting
Yes.
at is that, like, if you can wait, right? If you can wait out a market downturn, or you can wait out a change in interest rates, if you can wait out conditional changes and still continue to make your payments, time is on your side, and eventually you can usually come out of those adverse conditions, right, and keep servicing the loan. But it's true. And so, like, the longer time, one thing that we talk about a lot of Free to Grow CFOs, because a lot of brands are looking to purchase inventory with debt, right? And so one thing, we've come up with a bit of a framework that I've trained our team on, and it's basically like assess the risk right, in your sales forecast. And in simplest terms, we equate risk with uncertainty. So like the more uncertainty there is in the demand forecast you're using to, calculate that PO, the more uncertainty, the more risk. And the more risk, when we think about debt, right, there's a couple things you can do to try to align the use of debt with risk. The first one is, generally speaking, the more risk there is in your sales forecast, use less debt and more equity, right? Because there's less certainty. But the second thing, like you just mentioned, is choose debt with a longer time horizon. The most risky thing you can do is have a lot of uncertainty in your demand forecast, place a big PO, and have short-term debt that's due in, say, 90 days. That's super risky. But if that debt's due in 2 years, you can miss your sales forecast, but have 2
Yes,
years to figure it out,
that's right.
right? And so the time horizon, I'm just trying to give a practical example of why time horizon matters. And so I'm curious, you and I think both have some very clear opinions and or stories we can tell about this, but what are your thoughts on if and when SBA loans are a good idea for a fast-growing e-commerce brand?
I think that in some ways it's kind of like where you and I met, right?
Yeah,
When I
totally.
always say businesses don't grow in this nice straight line, they grow like this, and they have these little spurts. You spurt something, something comes or a customer comes along. There's some opportunity that you have a growth, a growth spurt. And what I think SBA loans can be very helpful is in those growth spurts to again, sort of flatten out some of your uncertainty in that, your forecast. And I really loved your piece on forecasts versus projections. And I think that that is a great place. So whether it's I need to invest in, I'm going to grow by this percentage, and when you grow, and you know this from the balance sheet, there's a part of those trading assets, your receivables and inventory, that are as your revenues continue to get higher, there's a piece that's never going to revolve, right? It's
Yeah,
there's and that's where permanent working capital comes in. That's where that little bit of SBA financing can come in. And I would tell you that the better you have your arms around your cash flow cycle and your cash flow forecast, 12 months, 18 months, the easier it is for a lender to say, look, you need, $375,000 in working capital to get you from this sales level to your forecasted sales level. And that's usually why people have a hard time because they can't do the analysis to help a lender get to that yes. But I
yeah,
think that's when, and it could be even you need to buy a piece of equipment. So if you're a manufacturer or, you need to find a piece of equipment, and even if you're a service business, let's say you have an opportunity to expand. I have a client who does daycare and her expansion is getting the next location. And she likes to buy the real estate, right? Because she's got that asset, for long term. This is another thing too, is that sometimes you expand by location, sometimes you add a product, sometimes you add to have people. And
hmm
working capital could be used for ad spend too. There's that's kind of like just cash, right? That you borrowed for 10 years. And the SBA's minimum kind of term for working capital is 7 years, but we go to 10. And so that's very common for us to underwrite a 10-year term on that. But
Okay,
yeah,
so
that's really the best time
well,
to
I thought of something. I just remembered something as you were talking. I'm smiling because this is something that I talk to people about a lot, and I just realized that I this idea came from you during our time at Guardian Bikes. Was this idea of permanent, like permanent working capital versus revolving
evolving.
fluctuations, we'll call it,
Exactly.
right? And so I want to break this down a little bit because this is key. So what Roxann is saying is like as you're scaling, right? If you think about, let's talk about inventory plus AR. That's your kind of major sources of, drivers of working capitals, the levels of those, right? So you may have, as you're scaling, you're increasing inventory levels and AR. And let's say you're also seasonal, which most brands that we work with are, right? So the seasonality component is what's driving this revolving need, meaning like think of peaks and valleys of your cash needs. Generally speaking, you have a valley of cash balance and a peak of cash need when seasonally your accounts receivable and your inventory need to be really high because of seasonality. And so you need to borrow during that kind of working capital peak, right, so to speak. But it's revolving, because when that seasonal spike goes away and you collect on that AR and you draw inventory levels down, you now have a trough of working capital needs and you have an excess of cash at that time. So there's this revolving piece. But as Roxann is saying, as you're growing, there's always, you find this permanent minimum, right? This
Yeah,
permanent minimum inventory level. You never go to zero, right? Generally speaking, AR never goes to zero. And so if you actually break out your projections of AR and inventory into like, here's my permanent minimum, but then here's my revolving peak and valley, right? That oftentimes is driven by seasonality or some big order on the wholesale side of your business, whatever. What you can do is you can have a piece of debt capital, the term loan, for example, which is not going to revolve. It's not going to go up and down with your needs, right? You're going to pay back evenly over 10 years, but that can be the source of capital that finances that permanent minimum, right? That minimum working capital need that your business always has. And actually, Roxann was savvy enough to suggest to us at Guardian Bikes that we have that term loan, and then on top of that, we had a revolving line of credit. I think it was called a cap line, right?
yeah,
And we could draw that up and pay it down
that's
with
right.
our seasonal needs. So now you're financing permanent working capital needs what this comes back to is a principle that I learned in school called maturity matching, which just means finance assets or working capital needs with debt, or we'll just say capital, but in this case, debt that matches cash flow. You want to match the cash flow generation from those assets with the pay down of the debt,
Exactly.
right?
Yes. And I think, with D2C brands, I don't see this mismatch maybe at the smaller. And when I think small, I'm think small and medium enterprise. For me, there's any company less than 1 million,
Mhm.
and those are pretty young companies. A lot of them don't have employees, but when you get over 1 million, like 1 million to 5, that's like a very interesting time for a business of any time, even a D2C brand. But I will see people buy fixed assets with their line of credit, and you
Yeah,
have to pay that line to zero, generally at least annually, if you want the lender to keep revolving it. If you, what we call evergreen it, meaning you draw it up and you leave it there, they'll eventually, either term it out over, few years, which is still not easy. You just won't be able to sit at that interest only for 10 years with the line of credit if you don't revolve it. You have to use it for the right asset that you're financing.
well, yeah. And so what you were just mentioning there, fixed asset, long-term asset, right?
Exactly.
Fixed asset produces cash flow over a long-term period, multiple years. Financing with a line of credit, which is short-term debt, right? That typically has to be paid down to zero every 12 months, generally speaking. So you're not following the maturity matching principle.
Really
Actually,
thinking about what is the term, what is your inventory turn and what is your receivable turn, right?
totally.
And this was the sort of the tricky part where I saw that Guardian they needed a fixed piece of working capital. And then you needed that revolver to get you through that time that you had to order your product until you got it on shore. And then on top of that, you had this very short, intense sales window.
Totally.
And
Yeah, I know. For us, it was like spring, summer, right? When everyone gets back outside, and then it was the holidays, and we always had to load up on inventory before that. But guess what? Sales were in a trough seasonally when we had to place those orders, right? And so I think the point that I want everyone to take away here is that if you're talking about an SBA term loan, again, that's something that's amortized, meaning you pay it back in even payments, right, over some time horizon. That can work if you're financing assets or working capital needs that follow that same timeline. So what I generally see for an e-com brand, let's call it an e-com brand that's seasonal, because so many of the brands we work with are, right, is that tends to be where I tend to see it be helpful to have a 10-year SBA 7(a) term loan is fixed asset purchases like equipment and real estate. And then the other one is equity buyouts. If you're going to buy
yeah,
out,
we'll talk a little bit about that next.
yeah.
Yeah.
So
That's
I
a
want to
whole
talk
other
about,
animal.
so, but it's because those are longer term. If you think about the time horizon of those
Yes.
asset purchases, those follow a longer time horizon. And usually inventory for most e-com brands, you need a line of credit that can revolve because your inventory needs are revolving in large part. And that's I don't want people to think that like they can't use a term loan, but if you're growing and you're seasonal, it's very hard. At Guardian, we ended up having to refinance out of it because we were growing so fast,
Fast.
and we ended up having to move on to
Wasn't
actually
enough.
an ABL. We had to move on to an ABL
Right.
after that.
And you could keep that term bit in place and, pay over time, because the other thing we did is that, and this is another important concept about SBA loans, is lien position on those trading assets. So generally, if you're not doing a revolving facility, SBA encourages lenders to not take a lien on the trading assets on inventory and receivables, because they want the business to have the ability to go out and get a line of credit. And if we take the whole thing, then somebody's going to come and say, hey, I need a line of credit. Can you subordinate that lien? And lenders are like, have a really tough time releasing collateral. So I
For
have a
sure.
philosophy. And also, anytime I do that, it's an expense, right? Anytime I have to modify a loan down the road, it's expense. So I try to say, how can we set this business up for success and not have to come in and do modifications down the road? And that's my personal philosophy and how I run my lending operations. But I do think that uh, you know, this idea of allowing the trade, if you have a line of credit, any revolving facility, they typically need, I don't care if you're asset based, borrowing base, no, criteria at all other than a first lien on your trading assets. So that's what we did. We gave the line the first lien on receivables and inventory, and we just took fixed assets of the business in the second position. And what I'm doing with an SBA loan there, I'm relying on the guarantee
Yeah,
instead of collateral. Okay, that's
for
the
sure.
trade-off right there. Because didn't really have, after the receivables and inventory, there wasn't much to the fixed asset bucket. So
Totally.
the other fundamental principle of SBA loans, besides being small, is reasonable assurance of repayment ability. That is the law. That's in the law itself. And I think that this concept, sometimes lenders, even my own underwriters, they get all, football, we don't have any collateral. And I'm like, let's start again. Do we have reasonable assurance of repayment ability? Talk to me about that and talk to me about the balance sheet. And then let's go talk about collateral. But I'm not, your
Yeah,
typical lender.
that's for sure. Well, and I think another thing that you just, as you were talking, that I just thought of, I think that for the average D2C brand, that's why if there are fixed asset purchases like or equity buyouts, it actually could be, you correct me if I'm wrong, but like if you buy equipment, let's say that you're vertically integrated, you buy equipment or you buy real estate, maybe you do an equity buyout, there's more there's more of a rationale there to sit down with the lender and say, I need you to carve out inventory and AR for our line of
Exactly.
credit, because you're going to have rights to the real estate as collateral. You're going to have a lien on the real estate. You're going to have a lien on this manufacturing equipment. And having those hard assets be the collateral for the SBA loan and having them carve out the AR and inventory for an asset-based lender, there's something more tangible there.
And I think that's an important part of, CFO work, is helping businesses navigate that concept, because it's not
Totally.
intuitive. It really isn't.
Totally.
And, the other thing I want to say is that I had mentioned not all SBA lenders will, you know, approach the business the same way. I feel very saddened that the SBA has given us a couple of different programs for revolving facilities, and lenders struggle with that.
I
I
know.
was at a conference and we talked about the cap lines, and I said, "What is the, issue? The is the borrowing base seems to come up a lot." I said, "Is it the business that has a problem with the borrowing base or the lender?" And guess what? It's both, right? So lenders struggle with the concept of borrowing base. In fact, you helped build my borrowing base
Yeah,
certificate,
I
right?
know.
Because
I know. I
we were
remember
going
that.
on this journey together, and you helped me develop that borrowing base certificate, which was great. But I think the other thing that I've noticed is that a lot of when you borrow when you get a line of credit, and let's say it's under $500,000, usually starts at 50, and maybe you get 100, and then you go a little higher as you grow. The thing is that on those smaller lines of credit, there is no control, right? The lender is not, there. It's usually like one and done, their credit score, that kind of thing. But as you do bigger credit facilities, lines of credit, there's going to be more analysis at the front end. But also, some lenders are going to require some sort of monitoring, and depending on the size, I think we were over 1 million at that time, so we did
Yep.
quarterly,
Yep.
and that's kind of consistent across most institutions. Maybe over 500 or over 1 million, you're gonna, and also the bigger institution, things are a little different. But that is the monitoring of the borrowing base is really helpful, and I think it's helpful to the business too. I really do. I
Totally.
think that is underappreciated by the owners.
So to draw a couple things out, one is the cap lines are, I guess I'll say in simple terms, ABLs through the SBA program effectively. And we had one that Roxann helped us put together when we had Guardian Bikes. I haven't found another bank that does cap lines. And I know there are others out there, but I know there's very few. But what I want the listeners to hear is that if you want to look for a revolving piece of debt, a line of credit akin to an ABL in the SBA world, what you should be asking for is the cap line program. That's what you should be
Yes,
asking for.
searching for that.
And what we had at Guardian was a 7A term loan that was financing our permanent working capital. And then on top of that, we had a cap line that was based on an advance rate against our inventory and an advance rate against our AR. That allowed us to borrow more than the term loan seasonally, but then pay that cap line down as we went from like a peak working capital need to a trough. And
And I
so,
think we structured it with like after your peak, we structured it with like a 90-day,
yeah,
to give you time to, process all that business and get back to
exactly.
your trough.
Exactly. But I think the point is, I would say the takeaway from this that I want people to hear is putting together debt structures is a strategic endeavor. It's not just I think one thing that I hate about just the lending that's available to e-com brands is that brand founders are getting all this cold outbound, like LinkedIn messages, phone calls, emails, and just saying you're approved for this amount of money. And here's the thing, we have to graduate from just, can I get the money I need to buy this, to can I get the right structured debt, right, for what my needs are now, and I'll say in the in the medium term, future. And all of these things we've talked about are things that you have to think about. And a good CFO understands what banks' credit boxes are for different products, right, and different classes of lenders. And they understand what is possible and what isn't possible. And then they come back and look at your business and say okay, I know a couple lenders where we're in their box, and I think we can structure this with this with this, and it's going to give us what we need to grow, but mitigate risk at the same time. That's the thing. You can't just take on debt. You have to take on debt and align it with the risk that lies ahead, because debt, I always tell people ask me is debt good or bad? Debt isn't good or bad. It's a tool. And if you use it incorrectly, it can put you out of business. It can create more risk. But if you use it correctly, it can enhance return on equity and it can help you get to your goals. But a CFO can help you use debt properly. One thing I want to do a sort of a little lightning round here on
Okay.
common misconceptions. Because there's some things that come up again and again and again when I talk to founders about SBA loans, and I want to debunk some of these myths. So, common misconception number one: I can get an SBA loan without a personal guarantee.
Yeah, that's a myth. SBA loans and most commercial loans, until you get into very, very large, size companies, any owner that has 20% or more ownership is going to have to provide a personal guarantee. Now, sometimes that personal guarantee may be depending upon where you are in the time of your business, where we are required to take, if we have a collateral shortfall, the SBA does say, hey, if the owners have equity in their personal real estate, you're obligated to take that. So those are two things that are true, absolutely true. But are they, the personal guarantee is all the time, 20% or more owners, and the taking a lien on your house really depends on the collateral available to secure that loan. And if you have equity, if you don't have equity, we don't take it.
Yeah, for sure, for sure. There's no point. That's just a lot of work for nothing. Here's another common misconception that I want to get alignment on. It's gonna take me 4 months to get approved because I've got to submit my application on the SBA's website.
That's not true at all. You submit your application to a lender. Okay.
Yeah, so
Now
I
there,
learned that working with you. I
yes,
thought that myth, and I met the guys at True Jerky who introduced us to you,
yes,
and they're like, "Dude, you don't have to get a loan through the SBA's website." He's like, "You go to a bank."
link. Right.
And I was like, "You go to a bank?" And then when
Yes.
I met you, you said, "Yeah, we're part of
Lender.
the PLP, right? Is that what it's called? PLP,
Preferred
preferred
lender
lender?"
program, yeah. Or they
Yeah.
now call it delegated authority. So we have
Okay,
a
got it.
delegated authority to originate a loan. And in fact, the loans that typically take that longer time are due to, I think, two or three things. Number one, typically the business is not prepared to borrow money. You don't have a balance sheet, you don't have tax returns, you don't have income statements, you don't have a forecast if it's required. So those are things that you have to provide. And if you don't have that available, that is typically a big drag. The other thing is that if the lender is not a delegated lender, they do submit a package to SBA. And that package has to be more complete at the time you go to SBA than I would have to do to make a credit decision. And there's a couple SBA forms that I need to have in hand. And I basically log into the SBA system and I put you in there. Now, there are a couple of new things that's happened since we last did a deal together, and that is that SBA has put in some risk mitigation tools. And this really came out of a fraud and PPP program. And the risk mitigation tools allows them, they do searches. And if there's anything that comes back, the business might have to clear that search or clear that issue, that risk that they've identified. And they work with the lender to do that. But generally, I try to set the expectations that we do a non-real estate loan, non-CRE, commercial real estate loan within 30 to 45 days, and real estate loans 45 to 60 days. If you have construction, it's going to be a lot longer. And that's another thing. You can finance leasehold improvements with an SBA loan. That's another thing that comes up. It's just like a little mini construction loan. And so there's certain things that can push your turn time, but I think most lenders try to do, working capital, business change of ownership. We went and talked about that, partner buyouts within 30 days, and commercial real estate within 45 to 60 days, no construction. Construction always just takes long. Startups, if you're a new business and you can find a lender who will do a pure startup, that's going to take longer
Yeah, for sure.
because it's just more moving parts. Yeah.
So here's the next misconception I want to ask you about. I can't negotiate any terms on my SBA loan.
Yeah, you can negotiate certain terms. There's things that you cannot negotiate. So the SBA, the maturities, the actual maturity of the loan, that's more dictated by the program. Interest rate. So the interest rate on a 7A loan is always pegged to prime, and the spread, there's a maximum spread. And these rates, when you think about a credit card, you'll go, wow, that SBA loan's a good deal. On a small loan, 250 and less, it's prime plus 4.5. 250 to, I think it's 500 is prime plus 4. And anything over that, it's prime plus 3.5. Not
Interesting.
12, not
Yeah.
25, not 100.
Yeah, for sure. Okay, so another one that comes up a lot. I can only borrow $5 million on SBA loans.
That's generally true. So your maximum exposure for your business and affiliates. I know one of the things that I had talked to um, one of your investors about, they were like, hey, can you give me one of these SBA loans for all the businesses that I have an investment in?
Yeah.
And I'm like, well, eventually so SBA requires that we input all owner data into their platform 100%. So they really can know it's not just this company that has a maximum of 5, it's the owners of the company. So if you have
Got it.
multiple businesses, we saw this a lot in the early days with hotels, right? So
Mhm.
hotels are a big ticket item. And, if you're a hotel developer and operator, you can only get so many SBA loans under that $5 million cap. There is a real estate program called 504. And there's ways that certain public policy objectives that could get you a little higher than 5. the one thing that's interesting today is that the Trump administration has developed, they haven't launched it yet, and I just pinged SBA to make sure it wasn't out, but they're developing a $10 million program for manufacturers.
Interesting.
It's consistent with the move,
Yeah.
like we're going to help smaller companies get access to capital to manufacture in the US.
That makes
So,
sense. I mean, I'm glad they're doing that because,
yeah,
today Guardian Bikes has a manufacturing facility, and the company since has done a little bit of equity raising, but also just recently did a $19 million loan deal with JP Morgan Chase that was announced in the news. But the point that I'm making is it takes capital, right, to get that going. It takes time and capital, not just one or the other. And so to put these tariff policies in place that give an incentive to manufacture domestically without the access to the capital can
yeah,
be a challenge, right?
right.
And
And I
so
think that is a really, I mean, I've always felt that from a, policy or a economic development standpoint, manufacturers are really, decent job creators, right?
for sure,
And that's one of the policy objectives is to create jobs. And they're the hardest to finance because the investment in fixed assets is significant. And then, your raw materials, your inventory
totally.
cycle, those are pretty expensive assets to finance. And it's hard for them to, manufacturers to get scale. So I like this. I know it's in the next appropriations bill for next year that they want to, make that an expansion for manufacturing. So that would be awesome if that happened.
Well, the other thing that I wanted to mention too is raw materials and work in process. Generally
Yes,
speaking, ABL lenders will not finance that. They'll make
exactly.
that ineligible. And so if you may
Permanent working capital, right?
exactly. So it's like it's a consumption of cash that's not generally it's a real consumption of cash, right? Of inventory,
Yes,
but not at the finished good level. And ABL lenders, they only lend against finished goods,
finished goods.
generally speaking. I've gotten exceptions for, an over advance for a season, right? But it's because their collateral is finished goods inventory and they want something that's readily available, requires no more investment or
Right,
processing to liquidate to make their loan whole. And so when you're converting to manufacturing, you're going to have to start taking on raw materials and work in process, which is not financeable. You may have an ABL at that time. Things are going great at the finished good level, but not at these, other levels of inventory. So I'm
like
curious. Go ahead.
I was gonna say, that's also why it's hard to finance, those types of trading assets because there's no collateral. And I
Totally.
just will say this is really important. Don't take no, push the fact that the lender has the SBA guarantee. If you have strong cash flow, you have good time in business, you have your arms really around your cash cycle, and you can show that, demonstrate that, man, don't take no. Just, say, hey, what about the fact that you can't that lenders are discouraged from declining SBA loans for collateral deficiency
Mm,
alone? It could be
interesting.
other stuff that cause you to
Yeah.
say no. But again, it's the same thing. I really have to work with my teams and wherever I've worked, other institutions. Let's start with repayment ability and then let's worry about capital once we get our minds around the income statement and the balance sheet.
It makes sense though that they discourage um denying a loan for collateral deficiency only because 75% of the loss is guaranteed, right? And so that would kind
Yes.
of defeat the whole purpose. But if they have cash flow history that demonstrates they can service the loan, that seems to me like a great use case for like, okay, so the SBA is going to plug the gap, the collateral deficiency gap with their 75% guarantee, but there's still strong cash flow that can be used to service the loan. And so that kind of advances, I would say, the mission of the
Of the
SBA
agency,
program, right?
yes. And I think the other thing too is that, you're not gonna get this type of financing by going online. You're just not that's not what the SB lenders that originate loans online are doing small working capital loans. That's it. So you're not gonna get what you need in that. And one of the other things I would say is, and this is a new thing that I'm seeing, people bank over here with some online bank, which is really great, but they can't lend you money. and you need to build a relationship with the bank and you need to shop for a bank that can grow with you. And
Hmm.
sometimes that might mean going to a bigger bank right off the top. But I will tell you that there are hundreds of excellent community banks that are big enough to grow with you. I mean, even when I was at, California Bank of Commerce, it was $1 million or $1 billion bank. And they were willing to trust, that there was something here, right?
Totally. Totally.
But I do feel that this is something that as you walk around and if you're getting a line of credit, they're going to want your operating accounts at the bank. But you kind of have to make sure the bank works for you from online banking, like
Totally.
the banking side, but also works for you from a debt side. And I think that
Totally.
is really important. It's another part of your scaling journey.
Absolutely.
Find that sweet
Well, and,
spot.
and it can, I know some founders, there's a couple founders I can think of that we work with that have, decent sized businesses, 50 million or so, very profitable. And they have their operating accounts and their credit cards and their line of credit all with JP Morgan
Here
Chase.
you go.
And the reason why it's really helpful is because and the owners also do their personal banking there. And so when you have everything there, your
Yes,
ability to negotiate or just structure, I don't want to say negotiate because you are negotiating, but the bank is like, hey, look, we're trying to keep this whole relationship in-house, right? So like it will make offers that they can't make to someone who has no other business with them, right? And if you think about their risk too, it's like, hey, look, your personal bank accounts are here. I can see how much money is in there. You're using
exactly.
your brokerage
Right.
accounts are with us. I can see what's
And
in there
particularly your business operating accounts, because if we start seeing, issues with operating accounts, we know that the loan is in jeopardy. So, now we want to go out and talk to you and say,
for
okay,
sure.
what's going on? Something is happening here that's not new. But that is, banks can be very helpful on the upside, but if something does go wrong, if you have that whole relationship, there's much more willingness
Totally.
to understand what's happening and what can we do within the criteria that banks have to work with to do modification or restructuring, and that's another piece that SBA can do. We can refinance debt that is not on terms that are reasonable for where you are today. The only thing, and this is new, but it's also new because it was a huge loss for the agency, is they will no longer refinance factoring lines and they will no longer refinance MCA contracts, merchant card
Yeah,
advance loans.
interesting.
They just too many losses, huge losses
Totally.
last year,
That makes sense. I
on that.
one last question. Can you refinance an SBA loan with another SBA loan?
You can. There are conditions that you have to have. So you have to get a decline basically from the lender who your current SBA lender to say, they are not willing to extend you any more credit for whatever reasons. The other thing is that, and this is another part of understanding the SBA marketplace, is that we sell our loans in the secondary market. So if an investor buys the unguaranteed portion of our loan, and you need to do something with that loan, you need to restructure the payments or something, we have to get their approval to do that.
Mm,
Right. And so that's another time when it makes sense for SBA to refinance, an SBA loan with another SBA loan. It's not as hard as it used to be, but it still, requires a little extra work. But before we finish, I really want to talk about, partner buyouts,
yes, absolutely.
business acquisition. So there's three pieces to this business that SBA calls it business change of ownership. There's 100% change of ownership. You're selling 100% of your company to someone else, or you're buying 100% of a company, right? So that's what they call 100% change of ownership. Then there's what they call a partner buyout. And it's not just partners, it'd be members, shareholders. But let's say you and I own the company 50-50 and I want out and you're going to buy 100% of my share. That's a complete change of ownership. I'm out, you take over my shares. And then they have what they allow now a partial change of ownership, which allows, let's say you have a dozen investors and two or three of them want out, but some of the other ones are willing to pick up, their ownership. Now, the key thing about these changes of ownership that you have to think about is the debt goes on, the obligor is the business And interesting, we co-borrow with the individuals. So
Interesting.
it's the only time an individual can borrow money from the SBA is when there's a change of ownership. And that is because the business is really the source of repayment. It's
Uh-huh.
not you're selling interest, you're selling equity. So that is the business is still the one that is going to be generating the cash flow to repay that debt. And it
And so
makes
is it's
sense.
from my understanding, it's underwritten based on the cash flow. Basically the business's ability to repay the loan from its cash flows. That's really
Right.
what the
Right.
underwriting is
And if
about, right?
I'm financing, let's say someone comes to me and they're buying a business and I'm underwriting the cash flow of the seller. But two things, and this also blows people's mind. No surprise. I want an opening day balance sheet. Can I just have an opening day balance sheet for the buyer? And I would like 2 years forecast, you know,
Yeah. Well,
just
what's interesting about this? I've never done one of these deals before, but I've always thought that it would be interesting to use an SBA loan to buy businesses. I think this is maybe like a later stage in my life, like when I'm
yeah,
done with Free to Grow CFO, or maybe while I'm still doing Free to Grow, but I want to like buy some brands or something. What's interesting about bringing in debt financing, if it's underwritten based on the seller, the company's ability to pay the loan back, it almost introduces this third party to basically underwrite the price of the deal, right?
exactly.
Because like I'm sure that you guys run into people who are under contract to purchase a business and you're like, the price is too high that if we finance this with an SBA loan, the business actually can't service the debt. Does that happen?
Yes. So and think about it. We're already doing a 10-year term on those change of ownership loans. 10-year. And if it doesn't cash flow over 10 years, something's wrong with that price.
For
But
sure.
additionally, we are required to get a business valuation. And, a lot of these firms that do these smaller SBA type transactions, they're very fluid in the metrics for a lot of different industries, right? Because we do so much of it. But yes, I mean, it does give you a independent third party who's taken a look at this deal and saying, "Oh yeah, we could finance that." The other thing to keep in mind on changes of ownership, if it's a complete change of ownership versus a partial, if it's a complete change of ownership, you're going to have to put at least 10% down. The SBA startups and changes of ownership stipulate a minimum of 10%. I personally wouldn't do a true startup, for less than 25. But, I've learned the hard way over the years that I've been doing this. And, but I do think that that is a strategy that you kind of need to keep in your back pocket, that an SBA loan can help you acquire or buy a partner who wants out,
Yeah, absolutely.
today.
So I want to recap a couple things before we close up here. So one, you can use an SBA loan to help scale your D2C brand, but it's important, and this is where a CFO can really help, to be clear about what you're financing, right? And what the cash cycle is of that piece of your business that you're financing, and understand that a 10-year term loan, which I would say is the most common because the revolving lines of
Yes.
credit through SBA just aren't that prevalent in the marketplace, those are best served to purchase fixed assets, like including equipment, real estate, and equity buyouts, whether that's a full acquisition of a business or it's buying out a partner. If you want to finance inventory with an SBA loan, you need to find a lender who is offering cap
Lines.
lines, SBA cap lines, which are like ABLs. And then going back to the misconceptions I asked Roxann about, you're going to have a PG if you do an SBA loan. You can get it approved on a normal underwriting timeline if you find a preferred lender. There are things that can be negotiated, but there are things like the PG that can't be
Mhm.
negotiated.
Correct.
You can have up to $5 million in exposure to the SBA program, and under certain conditions, you can refinance an SBA loan with another SBA loan. So,
Very good.
Roxann, what final thoughts do you have for the audience? Anyone who is intrigued by this conversation, what final thoughts do you have for them?
Yeah, I really feel it's important that you understand that not all lenders are the same, right? And even someone who does a lot of SBA loans may not be the right lender for you. The other thing is that I feel that not all lenders have the same talent on their team for
Totally.
underwriting. And it's important to try to find the right one. And if you get told no and you have a viable business, don't stop. knock on the next door.
I love
And
that.
you could ping me in on LinkedIn, and if I know of a lender who can do what you need, because I lend only in the Bay Area, San Francisco Bay Area. But if you need somebody, and I've been in this industry for 35 years, sometimes I know someone to call.
Roxann is very well networked in the SBA world. Don't let her downplay that. So, Roxann, where can people find more information about you and Fremont Bank?
Well, Fremont Bank, you can get us at fremontbank.com. And for me, I'm on LinkedIn.
Definitely check out. Feel free to reach out to Roxann if you have any questions about the SBA program. If you're in the San Francisco Bay Area, she actually might be able to do a deal for you. But Roxann, this was great. I've been wanting to have this conversation on the show for a while. This is honestly this was sort of like just a short snippet of what many phone conversations I've had with Roxann end up being about. So I'm super excited to be able to share this with our audience, and I'm so thankful that you came on today.
Thank you. I appreciate working with you always.
Absolutely. Well, until next time, everyone, scale on. Don't forget, if you liked today's episode, please hit the subscribe button wherever you're listening and leave us a review. It helps us reach more people like you. Also, if you want more tips on scaling a profitable D2C brand, follow me, John Blair, on LinkedIn. And if you're interested in learning more about how Free to Grow CFO can help your brand increase profit and cash flow as you scale, check us out at freetogrowcfo.com.